Most traders believe a bad entry becomes a bad trade only if they let it run too far. That sounds reasonable, doesn't it? But what if the truth is simpler and harder to accept? What if a bad entry is already a broken trade the moment it happens? Think about that for a second. If your entry is wrong, what exactly are you holding on to? A position or a hope? You've felt it before. The moment right after you enter, something feels off. Price doesn't behave the way you anticipated. It hesitates, stalls, or moves against you. Not violently, but subtly. And yet you stay. Why? Because you're waiting for confirmation, or maybe you're waiting to be proven right. But here's the observation most traders miss. The market rarely hides its disagreement with you. It shows it almost immediately. Now ask yourself, how often do your best trades hesitate? They don't. Strong trades move with clarity. They don't ask for your patience. They reward your timing. So if a trade starts with confusion, with friction, with doubt, what does that tell you? Let's break this down. A bad entry is not defined by loss. It's defined by misalignment. Misalignment between your expectation and actual market behavior. You expected expansion. Price compresses. You expected continuation. Price stalls. You expected momentum. Price fades. And here's the critical part. The longer you stay in that misalignment, the more your decision-making degrades. Why? Because now you're no longer trading the market. You're managing discomfort. Have you noticed how quickly your thinking changes once a trade goes wrong? You start justifying. You zoom into smaller time frames. You look for reasons to stay instead of reasons to exit. That's not analysis. That's attachment. And attachment is expensive. So how do you fix a bad entry instantly? You don't fix it by adjusting the trade. You fix it by recognizing it. That sounds almost too simple, doesn't it? But simplicity is where most traders fail, because they're conditioned to do more, not less. Let's go deeper. The moment you enter a trade, you should already know what correct behavior looks like. Not vaguely, precisely. Does price need to move immediately? Does it need to hold a level? Does it need to break structure? If that behavior doesn't appear quickly, why are you still in the trade? This is where most traders hesitate. They think, maybe it just needs more time. But time is not neutral. Time is information. When price doesn't move as expected, it's telling you something. The question is, are you listening? Consider this: the market rewards precision, not persistence. The longer you hold a bad entry, the more you're relying on luck, not skill. So the first application is simple, but uncomfortable. Define your invalidation based on behavior, not just price. Instead of saying, I'll exit if it hits my stop, ask yourself, what should price do immediately after I enter? And if it doesn't do that, get out. Not after a big loss. Not after confirmation. Immediately. Now you might wonder, won't that lead to overtrading? Won't you get shaken out too quickly? That's a fair question. But let me ask you this. What's more damaging, a small, controlled exit, or a trade that slowly turns into a problem? Because bad entries rarely explode against you right away. They bleed. They drain your focus. They occupy your mental capital. And by the time you exit, you're not just down money, you're drained. So the second layer is psychological. A bad entry tests your identity as a trader. Are you someone who reacts to information, or someone who defends decisions? There's a difference. Reactive traders stay flexible. Defensive traders stay stuck, and the market punishes rigidity. Let's make this practical. When you enter a trade, watch the first few candles closely. Not emotionally, objectively. Is there follow-through? Is there participation? Is there conviction in price movement? Or does it feel heavy, slow, uncertain? These are not random details. They are signals. If price hesitates where it should accelerate, that's not a neutral event. That's information. And here's where cause and effect come in. Hesitation leads to doubt. Doubt leads to hesitation in your decisions. And that hesitation compounds. But decisive exits break that chain. You exit early, not because you're afraid, but because you're precise, and precision builds confidence. Now think about this. What happens when you consistently cut bad entries early? Your losses shrink. Your mental clarity improves. Your capital stays intact. And most importantly, you're ready for the next opportunity. Because trading is not about being right on every trade. It's about being aligned with the right trades. So let's reinforce the core idea. A bad entry is not something you manage. It's something you remove. You don't negotiate with it. You don't adjust around it. You don't hope it improves. You recognize it and you act. And the faster you act, the less damage it does. But here's the part most traders overlook. This skill doesn't come from knowledge. It comes from honesty. Are you honest enough to admit you're wrong quickly? Or do you need the market to prove it to you? Because if you wait for proof, you're already late. Now imagine this scenario. You enter a trade. Within seconds, something feels off. Not dramatically wrong, just not right. What do? Do you sit and watch? Do you rationalize? Or do you trust that signal and step aside? That decision, right there, is where professionals separate from amateurs. Not in analysis, not in strategy, in response. And once you start responding correctly, something interesting happens. You stop fearing bad trades, because you know you won't stay in them. You stop needing perfect entries, because you can correct imperfect ones instantly, and that changes everything. But let me ask you one more question. What if the real problem isn't your entries at all? What if it's your refusal to admit when they're wrong? Because if that's the case, then the solution isn't in your strategy. It's in your behavior. And behavior, unlike the market, is something you can actually control. So the next time you enter a trade, don't just ask, where is this going? Ask, is this behaving the way it should? And if the answer is no, then why are you still in it? Because the truth is, the market gives you an opportunity to fix a bad entry almost immediately. Most traders just choose not to take it. The first few moments after you enter a trade carry more truth than most traders are willing to accept. Not later. Not after confirmation. Right at the beginning. That's where the market shows its hand. Quietly, but clearly. You enter with an idea. You've seen a setup, a level, a pattern that suggests movement. But the moment you're filled, the market begins to respond to your decision. And that response is not random. It's information. So what happens next? Does price move with intent, almost as if it agrees with you? Or does it stall, hesitate, and drift as if your timing is slightly off? That difference, subtle as it may seem, is everything. Most traders ignore this phase. They believe the trade needs time to develop. But let's question that. Why should a strong idea need time to prove itself? If your entry is aligned with real momentum or genuine interest in the market, shouldn't that show up quickly? Think about your best trades. The ones that felt effortless. Did they sit still after you entered? Or did they move with clarity, almost immediately reinforcing your decision? That's not coincidence. That's alignment. Now compare that to trades where you feel uncertain right after entry. Price ticks up and down. No clear direction. No follow-through. You start watching more closely. You start thinking more. You begin asking yourself, is this still valid? But here's the deeper issue. Why are you asking that question after you've already entered? Because something is off. And that off feeling isn't emotional weakness. It's observation. It's your mind recognizing that price behavior is not matching your expectation. But instead of acting on that information, most traders override it. They tell themselves to be patient. They look for confirmation that hasn't come yet. They zoom into smaller time frames, searching for reasons to stay. And in doing so, they miss the most honest signal the market gave them. The initial reaction. The first few moments matter because they are clean. They are not yet influenced by your bias, your stress, or your need to be right. They are simply price responding to your entry level. If there's strength, you'll see it. If there's weakness, you'll feel it. So why ignore that? Because acting on it requires something uncomfortable. It requires letting go quickly. It requires accepting that your timing might be wrong, even if your idea is right. And that's where most traders hesitate. They don't want to exit too early. They fear missing out if price eventually moves in their favor. So they stay. They wait. They give the trade room. But what they're really doing is giving uncertainty more time to grow. And uncertainty doesn't stay neutral. It turns into doubt. Then doubt turns into hesitation. and hesitation affects every decision that follows. All of this starts in those first few moments. If you train yourself to observe that phase carefully, without bias, you begin to see patterns. You notice how good trades behave almost immediately. You notice how weak trades reveal themselves early, not later. And once you see that consistently, your approach changes. You stop thinking in terms of win or lose. You start thinking in terms of aligned or misaligned. Because a trade that doesn't behave correctly from the start is not neutral. It's already out of sync with your expectation, and staying in a misaligned trade doesn't improve it. It only delays your response to it. So the next time you enter, don't look ahead. Don't think about targets or outcomes. Watch what happens right after. Strong trades don't wait around to convince you, they move. Not wildly, not chaotically, but with direction, with intent. There's a sense of flow to them, as if the market already knows where it wants to go and your entry simply aligns with that movement. So what does hesitation mean? Most traders interpret hesitation as neutrality, a pause, a moment where the market is deciding. But that assumption can be dangerous, because in reality, hesitation often reflects a lack of agreement with your idea. If your entry is truly in sync with market momentum, why would price stall right after you enter? Why would it linger around your entry, moving back and forth, testing your patience? That behavior is not random, it's a message. Think about how momentum works. When there's real participation, buyers stepping in or sellers taking control, price tends to move efficiently. It doesn't hover, it doesn't struggle, it expands. So when you see the opposite, slow movement, overlapping candles, inconsistent pushes, it suggests something is missing. Conviction? And without conviction, your trade is no longer what you thought it was. Now ask yourself, how many times have you entered a trade expecting continuation, only to watch price hesitate? At first, it seems harmless. You tell yourself it just needs time. But as seconds turn into minutes, that hesitation starts to feel heavier. You begin watching every tick. You become more involved. Your focus narrows. Why? Because the trade is no longer working as expected. Hesitation creates a subtle tension. It doesn't trigger immediate fear, but it introduces doubt, and that doubt changes how you behave. Instead of observing, you start hoping. Instead of reacting, you start waiting. And waiting in this context is rarely neutral. Because while you're waiting, the market is still providing information. It's showing you that your timing might be off, that your entry might not be as strong as you believed. But most traders ignore that signal. They treat hesitation as a temporary inconvenience rather than a meaningful clue. And that's where problems begin. A hesitant trade often leads to one of two outcomes. Either it eventually moves in your favor, but with reduced clarity and increased stress, or it slowly drifts against you, turning into a loss that feels avoidable in hindsight. In both cases, the early hesitation was the first sign, but it was dismissed. Let's look at this differently. If strong trades move quickly, then speed becomes a form of confirmation, not in the traditional sense, but in behavior. The market doesn't need to tell you with indicators or signals. It shows you through movement. So when that movement is absent, what are you really seeing? You're seeing a lack of alignment, and alignment is what gives trades their edge. Without it, you're left managing uncertainty instead of riding momentum. Now consider the psychological effect. When a trade moves quickly in your favor, your thinking stays clear. You're not questioning your decision. You're simply managing the trade. But when a trade hesitates, your mind becomes active. You start analyzing more. You look for reassurance. You second guess. That shift from clarity to overthinking is not just mental. It affects your execution. You hesitate to exit. You hesitate to add. You hesitate to act. And all of that begins with the market hesitating first. So the key is not to tolerate hesitation, but to recognize it for what it is. A signal. Not always a reason to exit immediately, but always a reason to pay attention. Is this the kind of movement you expected? Is this the behavior that supports your idea? Or are you staying in the trade because you don't want to be wrong? Because if the strength you anticipated isn't there, then what exactly are you holding on to? A position or an assumption? And once you start asking that question honestly, you begin to see hesitation differently. Not as a pause. Time feels harmless in a trade. It doesn't hit your account like a loss does. It doesn't trigger the same urgency. In fact, it often feels like an ally, something that gives your idea space to work. But what if time isn't helping you at all? What if time is quietly increasing your risk while you're sitting still? Most traders assume that if price hasn't hit their stop, the trade is still valid. That as long as the level holds, they're safe. But that belief ignores something critical. Markets don't just communicate through levels, they communicate through behavior over time. So let's question this. If your trade idea is correct, what should happen after you enter? Should price linger around your entry, moving slowly, showing no urgency? Or should it begin to move with purpose, even if not immediately, at least with some form of follow-through? Because if that follow-through doesn't appear, time starts to tell a different story. Every moment that passes without confirmation is not neutral. It's information. It's the market showing a lack of interest at your level, a lack of participation in your direction, and lack of participation is risk. Not visible risk, not dramatic risk, but real risk. You might still be at break-even. You might even be slightly positive. But the longer price stays inactive or uncertain, the more your original premise weakens. Have you noticed how trades that take too long to work often feel heavier? You find yourself watching them more closely. You check your chart more often. Your attention narrows. Why? Because deep down, you sense that something isn't right. Time is exposing that. But instead of interpreting it as a warning, most traders interpret it as patience. They tell themselves they're being disciplined by staying in the trade. They believe they're giving the setup room to breathe. But there's a difference between patience and passivity. Patience is waiting for a valid setup. Passivity is staying in an invalid one. And time is what separates the two. Let's go deeper. When a trade doesn't move as expected, your mental state begins to shift. At first, you're confident. Then you become observant. Then you become cautious. And eventually you become defensive. You start protecting the trade instead of evaluating it. And all of that happens gradually as time passes without confirmation. Now consider the alternative. What if you treated time as a condition of your trade, not just a background factor? What if your idea required not just a price level, but a timely reaction? That changes everything. Now instead of asking, is my stop hit? You start asking, is this still behaving as expected within the time it should? Because a strong setup doesn't just reach your level, it reacts to it. And that reaction has a rhythm. If price reaches your entry and then does nothing for an extended period, that rhythm is broken. The energy you expected isn't there. The momentum you anticipated hasn't shown up. So what are you really holding at that point? Not a strong trade. Not a clear idea. Just a position waiting for something that may or may not come. And while you're waiting, your risk is increasing. Not in distance, but in uncertainty. Uncertainty affects your decisions. It slows your reactions. It makes you hesitate when you should act. So even if price hasn't moved against you yet, the quality of your trade is already deteriorating. And deteriorating trades rarely improve with time. They either stay stagnant or eventually move against you. So the question becomes, how long is too long? There's no fixed answer. It depends on your setup, your time frame, your style. But there is a consistent principle. If the behavior you expected doesn't show up within a reasonable window, the trade is no longer what you thought it was. And once that happens, staying in it is no longer a strategic decision. It's an emotional one. Because now you're not trading what is happening. You're holding on to what you hoped would happen. Managing a bad entry feels responsible. It feels like you're doing something, adjusting, adapting, giving the trade a chance to work. But look closely, and you'll notice something uncomfortable. Most of that management is just postponement. You enter a trade, and almost immediately, it doesn't behave the way you expected. Not dramatically wrong, just slightly off. Price hesitates, moves unevenly, lacks follow-through. And instead of stepping out, you begin to manage. You widen your mental tolerance. You tell yourself it's still within range. You shift your expectations just enough to justify staying. But let's question that. If the entry is already showing signs of weakness, what exactly are you managing? Are you improving the trade or protecting your decision? Because real management happens in good trades. Trades that are working, that are aligned, that are moving with intent. In those situations, managing makes sense. You're optimizing something that already has strength. But when a trade is weak from the start, management becomes something else entirely. It becomes negotiation. You start negotiating with price. If it holds here, I'll stay. If it pushes a little higher, I'll feel better. You create conditions after the fact, trying to rebuild confidence in something that never had it. And every adjustment you make pulls you further away from your original plan. Now, ask yourself, if you need to keep adjusting your expectations just to stay in the trade, is the trade really valid? Or are you slowly convincing yourself it is? This is where most traders get trapped. Not by the market, but by their own flexibility in the wrong direction. They think adaptability is a strength. And it is, when it's applied to new opportunities. But when it's used to justify a bad entry, it becomes a liability. Because now you're no longer reacting to clear signals. You're reacting to discomfort. And discomfort has a way of distorting judgment. You start focusing on avoiding a loss instead of making a good decision. You hold through indecision. You wait through weak behavior. You manage something that doesn't deserve management. And all of this takes time. Time that could have been used to reset, to find a better entry, to stay mentally clear. Instead, it gets spent on a trade that was flawed from the beginning. Let's take it a step further. When you manage a bad entry, you're not just delaying the exit, you're changing your relationship with the trade. You become invested in it, not financially at first, but emotionally. You've put effort into it. You've adjusted around it. You've given it attention. So now, exiting feels harder. Because it's no longer just a trade. It's something you've tried to make work. And that's where objectivity disappears. You stop seeing the trade for what it is. You start seeing it for what you want it to become. But the market doesn't respond to your effort. It doesn't reward your patience if the premise is wrong. It simply continues to move based on its own conditions. So all that management, all that adjustment, doesn't change the outcome. It only delays your recognition of it. And that delay has a cost. Not just in money, but in clarity. Because once you're caught in managing a bad trade, your focus narrows. You're less aware of new opportunities. You're less responsive to better setups. You're tied up. Now imagine the alternative. You enter a trade, it doesn't behave as expected. You recognize it quickly. You exit. No adjustment. No negotiation. Just a clean decision. What happens then? You're free. Free to observe. Free to reassess. Free to act again without bias. That's real control. Not controlling the trade, but controlling your response to it. So the next time you feel the urge to manage a trade that isn't working, pause for a moment. Ask yourself, am I improving this position or am I avoiding the decision to exit? Emotional attachment doesn't begin when a trade goes deep into loss. It begins much earlier, at the exact moment you choose to ignore what the market is showing you. You enter a trade with a clear idea. There's logic behind it, structure behind it, but soon after entry, something doesn't quite line up. Price hesitates. It fails to follow through. The reaction you expected isn't there, and in that moment, you have a choice. Do you accept what you're seeing, or do you look past it? Most traders look past it. They don't call it attachment. They call it patience. They tell themselves they're being disciplined by sticking to the plan. But something subtle has already shifted. They are no longer observing the trade. They are protecting it. Ask yourself, when you ignore early signs of misalignment, what are you really doing? You're making a quiet decision to stay committed, even when the evidence begins to weaken. And that commitment, small as it seems, is where attachment takes root. Because once you've decided to stay despite contradiction, your mind begins to adapt around that decision. You start filtering information differently. Signals that support your trade feel more important. Signals that challenge it feel less relevant. You don't notice this shift happening, but it's there. Slowly, your objectivity starts to fade, and that's where the real cost begins. Because now you're no longer evaluating the market clearly. You're interpreting it through a position you've already chosen to defend. Think about how quickly your thinking changes. At first, you're analytical. You're reading price, watching behavior, but after you ignore that first sign of weakness, you become selective. You look for confirmation. You seek reassurance. Why? Because you've become invested, not just financially, but psychologically. You've taken a stance, and now your mind wants consistency. It wants to avoid the discomfort of being wrong. So it works quietly in the background, shaping your perception to support your position. And the longer you stay, the stronger that attachment becomes. You start justifying. You adjust your expectations. You reinterpret the setup. What once felt uncertain now starts to feel still valid. Not because the market improved, but because your tolerance expanded. But here's the problem. The market hasn't changed. Only your perception has. And trading based on altered perception is no longer trading. It's defending. Now consider what happens next. As attachment grows, your flexibility shrinks. Exiting becomes harder. Not because the trade is better, but because leaving it feels like admitting something. Admitting you were early. Admitting you were wrong. Admitting you misread the situation. And for many traders, that's more uncomfortable than taking a loss. So they stay. They stay through hesitation. They stay through weak behavior. They stay through signals they would normally respect if they weren't already in the trade. That's the trap. The same trader who would clearly see a bad setup from the outside becomes blind to it from the inside. All because of one moment. The moment they chose to ignore what didn't align. Let's bring this back to awareness. If you want to avoid emotional attachment, you don't fight it later. You prevent it early. You stay honest at the beginning. When price doesn't behave as expected, you acknowledge it immediately. You don't reinterpret it. You don't soften it. You don't delay your response. Because the longer you delay, the more your mind adjusts around the trade. And once that adjustment happens, you're no longer in control of your decisions in the same way. So the key is not emotional discipline in the middle of a losing trade. It's clarity at the start. It's the willingness to say, this isn't right, before your mind has time to build a story around it. Most traders spend their energy trying to perfect their entries. They refine setups, tweak confirmations, wait for the cleanest signal. It feels logical. If the entry is perfect, the trade should work. But let's question that. How often do perfect-looking entries still fail? And how often do imperfect ones work out anyway? The difference isn't always in how you enter. It's in how you respond after you enter. Because no matter how refined your strategy is, you will have imperfect entries. The market doesn't operate on your level of precision. It moves on participation, on timing, on forces you can't fully control. So if imperfection is inevitable, what becomes more important? Your exit. Not just where you exit, but how precisely you do it. Precision in exits means recognizing when the trade is no longer aligned and acting on it without delay. It means cutting exposure before it grows, not after it becomes obvious. But most traders do the opposite. They demand perfection at the entry and tolerate imprecision at the exit. They hesitate when it's time to close. They give extra room. They wait for confirmation. They turn a small mistake into a larger one, all while believing the entry was the problem. But was it? Or was it the delay in response? Think about this. If you enter slightly early, but exit quickly when the trade doesn't behave as expected, what happens? You take a small loss. Your capital stays intact. Your mindset stays clear. You're ready to try again. Now compare that to a perfect entry that you manage poorly. You get in at the right level. Everything looks good. But when the trade starts to weaken, you hesitate, you wait, you hope it recovers, and slowly, that perfect entry turns into a loss that could have been avoided, or at least minimized. So which matters more? Getting in perfectly, or getting out precisely? Precision in exits is what protects you from uncertainty. It's what limits damage before it compounds. It's what keeps your decisions clean, even when your entries aren't. But achieving that precision requires something most traders resist. Speed. Not rushed decisions, but timely ones. When the market shows you that your expectation isn't playing out, you act. You don't wait for it to become obvious. You don't need full confirmation. You rely on behavior, not just levels, because behavior changes before outcomes do. And if you wait for the outcome, a clear loss, a broken level, you're already late. Now ask yourself, what makes exiting so difficult? It's not a lack of knowledge. You know where your stop is. You know what invalidation looks like. It's hesitation.